They waited until the very last moment. They waited until the volumes were thin. They waited until the books were closing. And then, on the final trading day of the year, they pulled the rug. If you're looking at your screen right now, you're seeing a sea of red. Silver is collapsing, down nearly 8% in a matter of hours. Just days ago, silver was trading near the highs. Confidence was building. Momentum was accelerating. The breakout looked real. And now, suddenly, it's gone. For many investors, this doesn't just feel like a loss. It feels like a betrayal. You held through the volatility. You believed the trend. You stayed calm while the market tested your patience. And now, just hours before the new year, your portfolio is bleeding. But listen carefully. What you're witnessing is not a change in trend. It is not a signal that silver is dead. It is not the end of the story. What you are watching is something far more dangerous. This is a liquidity event. This is a dash for cash, and it has nothing to do with fundamentals, and everything to do with how the global financial system really works when the clock runs out. Because December 31st is not just another date on the calendar. For banks, December 31st is not a trading day. It is an accounting day. At midnight, regulators take a snapshot, a cold, unforgiving snapshot of every major bank's balance sheet. That snapshot determines capital requirements, it determines leverage limits, it determines systemic risk scores, and it determines who survives the next year comfortably, and who enters it under pressure. Banks know this, and banks act accordingly. As the year closes, they do not think like traders. They think like accountants. They think like risk managers. They think like institutions that must look strong on paper no matter the cost. So what do? They raise cash. Not slowly, not carefully. Aggressively. They dump assets. They cut exposure. They sell anything that carries volatility or regulatory weight. And precious metals, especially silver, sit directly in the crosshairs. This is why gold and silver are falling together, not because they are weak, but because they are liquid. In moments like this, liquidity is not your friend. It makes you the first target. Silver is not being sold because it has failed. Silver is being sold because it can be sold fast. This is not panic from retail investors. Retail doesn't have the size to do this kind of damage. This is institutional pressure. This is balance sheet engineering. This is forced behavior driven by regulation, not emotion. And behind it all sits one word that most people ignore until it's too late. Basel III, rules written quietly, implemented slowly and enforced brutally at year end. These rules change how banks treat assets. They change how risk is calculated. They change what must be held and what must be reduced before the clock strikes midnight. And every year the same pattern repeats. Thin liquidity, sudden selling, sharp drops that make no sense until you understand the timing. This is the final flush, the last shake of the tree, the last attempt to scare weak hands out of position, the last chance to clean the books before the calendar resets. And if you don't understand what you're seeing, you'll assume the worst. You'll think the market is broken. You'll think the thesis is dead. You'll think the move is over. That is exactly what this moment is designed to make you believe. Because the most effective sell-offs happen when confidence is highest and attention is lowest. New Year's Eve, thin markets, closed desks, distracted investors, perfect conditions. This is not chaos, this is precision. And it always happens when people least expect it. To understand what just happened to silver, you have to forget charts for a moment. Forget candlesticks, forget indicators, forget sentiment. Because this move was not born on a trading screen. It was born inside balance sheets, inside regulatory frameworks, inside risk models, inside rules that most investors never read, but that govern everything once the calendar turns red. The silver crash did not begin with selling pressure. It began with constraint. Banks do not operate freely. They operate inside cages made of ratios, requirements, and regulatory math. And at year end, those cages tighten. This is the part of the market cycle where choice disappears. When you hear the phrase forced selling, most people imagine panic. They imagine fear. They imagine traders hitting the sell button to avoid losses. That is not what this is. This is selling without emotion, selling without opinion, selling without debate. This is selling because the system demands it. On December 31st, banks are judged, not by profits, not by performance, but by how their balance sheets look at a single frozen moment in time. That snapshot determines how much capital they must hold. It determines how much leverage they are allowed next year. It determines whether they are considered stable or risky. And risk, at year end, is poison. So banks do what they always do when survival is on the line. They reduce risk first and ask questions later. Silver is considered volatile. Silver is considered non-yielding. Silver is considered an asset that can move violently under stress. That makes it expensive to hold under Basel III capital rules. Under these rules, not all assets are treated equally. Cash is king. Treasuries are favored. Certain assets receive preferential treatment. Silver does not. And when the cost of holding an asset increases overnight, the decision becomes mechanical. You sell it. Not because you want to, Because you must. This is why the drop looks sudden. This is why it looks aggressive. This is why it feels unnatural. Because it is. This is not the invisible hand of the free market. This is the iron fist of regulation. As December comes to a close, banks run simulations. What happens if volatility spikes? What happens if asset prices move against us? What happens if regulators mark us harshly? And when the models light up red, there is no negotiation. Assets get dumped. Silver futures, silver derivatives, silver exposure of every kind. This selling pressure does not trickle into the market. It hits all at once, because every major institution is responding to the same clock, the same deadline, the same rules, the same fear of being penalized for looking risky at the wrong moment. This is why silver and gold fall together, not because they are correlated in value, but because they are correlated in treatment. They are both considered non-productive assets. They do not yield interest. They do not generate cash flow. In a risk-averse accounting framework, that makes them expendable, so they are sacrificed. And this is where most investors get it wrong. They see price falling and assume demand is disappearing. But demand is not disappearing. It is being temporarily suppressed. The selling is not the market voting against silver. It is institutions' cleaning house. Think of it like this. Imagine a store forced by law to clear its shelves on December 31st, not because the products are bad, but because regulations change on January 1st. The store discounts everything. Prices collapse. Outsiders panic. But the inventory never lost its value. The timing did. This is exactly what happens in year-end liquidity events. And silver is especially vulnerable because of one key factor. Leverage. The silver market is heavily leveraged. Paper silver vastly outweighs physical silver. For every ounce of physical silver, there are dozens of paper claims, futures, options, ETFs, swaps. These instruments amplify price moves when forced selling begins. Once prices start falling, margin calls appear. And margin calls do not care about your long-term thesis. They care about cash. Now, positions are closed automatically. Collateral is liquidated. Selling feeds, selling. This is how an 8% drop happens without warning. Not because everyone suddenly changed their mind, but because leverage turned pressure into collapse. And here is the most misunderstood part of all. This is not manipulation in the cartoon sense. No secret room, no single villain pushing a button. This is systemic behavior. Rules create incentives. Incentives create behavior. Behavior creates outcomes. The outcome you are seeing is the logical result of a system that prioritizes appearances over fundamentals at specific moments in time. Year-end is one of those moments, and it happens every year. Sometimes in equities, sometimes in bonds, sometimes in commodities. This year, silver was in the crosshairs. Why? Because silver had run too far, too fast. It had attracted speculative money. It had built leverage. It had become visible. Visibility is dangerous when liquidity dries up. Thin markets magnify every order. Every sell hits harder. Every bid disappears faster. This is why they waited. They waited until volumes were thin. They waited until traders were distracted. They waited until liquidity was weakest. Then they sold, not randomly. Strategically, this is what professionals do. They don't fight the market. They use its weaknesses. And December 31st is the weakest day of the year. Now let's address the psychological damage. Because this event is not just about price. It is about belief. The most powerful crashes don't destroy capital. They destroy confidence. They make investors question themselves. They make them doubt their thesis. They make them abandon positions at the worst possible moment. This is why the timing matters. Hours before the new year. Hours before optimism resets. Hours before fresh capital returns. Fear is amplified because the calendar is changing. People want closure. They want clean slates. They want to start fresh, so they sell. And that selling creates the illusion of finality. But it is an illusion. Because once the snapshot is taken, the pressure disappears. Once the books are closed, the rules reset. January is not December. January is when capital flows return. January is when institutions rebuild exposure. January is when positioning begins again. The same assets that were toxic days ago suddenly become attractive. This is not theory. This is history. Year after year, markets punish those who confuse forced liquidation with fundamental weakness. Silver is not dropping because it failed. It is dropping because it is being used. Used to raise cash, used to satisfy ratios, used to survive an accounting deadline. And once that deadline passes, the reason for selling disappears. What remains is the asset itself. Unchanged, unbroken, still scarce, still industrially critical, still monetarily relevant. The irony is brutal. The moment that feels like defeat is often the moment of maximum pressure. And maximum pressure is where reversals are born, but only for those who understand what they are watching. Everyone else sees a crash. Those who understand see a mechanism that operates on a schedule, a mechanism that does not care about emotions, a mechanism that repeats because the system demands it. This is not the end of silver's story. This is the system exhaling after holding its breath all year. The psychology of the final flush. How fear is engineered at the worst moment. The most important thing to understand about this crash is not what happened on the chart. It's what happened inside the human mind. Markets are not moved by numbers alone. They are moved by perception, pressure, and timing. And this event was designed, whether intentionally or structurally, to strike at the exact psychological breaking point. The final trading days of the year are unlike any other moment in financial markets. They are quiet, they are thin, they are emotionally charged, people are tired, funds are exhausted, traders are mentally checked out, attention is fractured, some desks are already closed. Some managers are already on holiday, some systems are running on autopilot. This is when markets are most vulnerable, not to chaos, but to precision, because fear does not need volume to spread. It only needs timing. When silver collapsed, it didn't just hit balance sheets, it hit expectations. Just days earlier, sentiment had flipped bullish. Analysts were talking about breakouts. Retail confidence was growing. Momentum traders were entering. That optimism is not an accident. Markets tend to build hope before they deliver pain, because hope creates exposure. Exposure creates leverage, and leverage creates fragility. The silver market was fragile not because it was weak, but because too many people were positioned the same way. When positioning becomes crowded, the market becomes unstable, not because the thesis is wrong, but because there is no room left for error. And year-end provides the spark. Here is where psychology takes over. When prices start falling suddenly, the first reaction is confusion. What just happened? Why is this dropping? There's no news. Confusion quickly turns into anxiety. Anxiety turns into fear. And fear turns into action. The human brain is wired to avoid pain more strongly than it seeks reward. This is loss aversion. And during sharp sell-offs, loss aversion dominates logic. People don't ask, why is this happening? They ask, how much more can I lose? That question is deadly because it pushes investors to make decisions based on emotion, not understanding. This is where the final flush does its real damage, not by destroying value, but by forcing people out at the worst possible moment. Let's be very clear about something. Most people do not sell at the top, and most people do not buy at the bottom. They sell when pain becomes unbearable, and pain is greatest when expectations were highest. Silver did not collapse in silence. It collapsed loudly, violently, and publicly, and that is not random. A slow decline allows people to adjust. A violent drop shocks the nervous system. It triggers fight or flight. In financial markets, flight means liquidation. And this is where the system feeds on itself. As prices fall, stop-loss orders are triggered. As stops trigger, prices fall faster. As prices fall faster, margin calls begin. Margin calls are mechanical. They do not care about your conviction. They do not care about macro trends. They do not care about history. They care about collateral. If collateral drops below a threshold, positions are closed automatically. This is forced selling layered on top of forced selling. And it always accelerates faster than people expect. The market doesn't ease into panic, it jumps. Now consider the timing again. New Year's Eve. Emotionally, this is a moment of reflection. People are reviewing performance. They are looking at gains and losses. They are already sensitive. When losses hit at this moment, they feel final. They feel symbolic. This is how the year ends. This is the truth. This is what the market really thinks. That narrative is powerful and dangerous because markets do not care about symbolism. They care about flows. And flows at year-end are distorted. This distortion creates false signals, signals that feel real but are temporary. This is where inexperienced investors are hurt the most. They confuse liquidity-driven moves with fundamental judgment. They assume price equals truth. But price, in moments like this, is simply the result of pressure. Think of a spring. Like when pressure is applied, it compresses. And the more pressure, the tighter it coils. But compression is not destruction. It is stored energy. And when the pressure is released, that energy moves violently in the opposite direction. The final flush is compression. It is the moment when pressure peaks. And pressure peaks when belief collapses. Now let's talk about narratives. Because narratives are weapons. During sharp sell-offs, certain stories always emerge. Silver is dead. The breakout failed. The market has spoken. These narratives are comforting in a strange way. They offer closure. They give people permission to exit, and they spread quickly because fear is contagious. But narratives formed during forced liquidations are almost always wrong, because they are built on distorted prices. This is why professionals behave differently. They do not ask, what does the price say? They ask, why is the price moving? And more importantly, who is being forced to act? In this event, the answer is clear. Banks, funds, institutions under regulatory pressure. Not long-term holders changing their view. Not industrial users abandoning demand. Not a collapse in silver's role. just forced behavior at a specific moment in time. And once that moment passes, behavior changes. But psychology lags. Even after selling pressure ends, fear remains. People hesitate. They wait. They doubt. This hesitation is what allows prices to recover quietly. By the time confidence returns, the move is already underway. This is why reversals feel unfair. They don't announce themselves. They happen when disbelief is highest. Now let's examine one of the most misunderstood emotions in markets: regret. After a crash, there are two types of regret: regret from holding and regret from selling. In the moment, holding feels painful. Selling feels like relief. But relief is temporary. When prices stabilize, and they always do, a new emotion appears. What if I sold the bottom? That regret is far more corrosive. It erodes trust in one's own judgment, and investors who lose trust in themselves become reactive. They chase moves. They hesitate at entries. They exit too early. This is how the system extracts value over time, not through one crash, but through repeated psychological wounds. The final flush is one of the most effective tools in that process. It cleans the books, it resets positioning, and it transfers conviction from weak hands to strong ones. This is not conspiracy. This is structure. Markets are ecosystems. They reward patience. They punish emotional certainty. And they are ruthless toward those who do not understand timing. Now consider silver's role again. Silver sits at the intersection of two worlds. It is a monetary metal, and it is an industrial metal. That dual nature makes it volatile, but essential. It is used in electronics, in solar panels, in medical applications, in infrastructure. Demand does not disappear overnight. What disappears is speculative tolerance, and when tolerance collapses, price overshoots. Overshoots to the downside, just as it overshoots to the upside. The final flush is the overshoot. It is the point where logic breaks down, where selling continues, even when selling makes no sense, where people sell not because they want to, but because they cannot emotionally endure another red candle. That is capitulation. And capitulation is not an end. It is a transition. The market does not collapse into nothingness. It moves from weak conviction to strong conviction, from leveraged hands to patient hands, from emotional ownership to strategic ownership. This transfer is never comfortable, and it never feels obvious. That is why it works. If it felt safe, it would fail. The truth is uncomfortable. This drop in silver is not proof that the story is over. It is proof that the system has reached a stress point. And stress points precede change, but not the kind of change most people expect. Not collapse. Rebalancing, resetting, repositioning. The system does not destroy valuable assets. It redistributes them, and it does so using fear as the mechanism. By the time calm returns, ownership has changed. And those who understand this process stop asking, why did this crash? They ask a different question. Who sold and who bought? Because every forced seller creates a patient buyer. Every liquidation creates accumulation somewhere else. That is how markets survive. And that is why moments like this matter far more than headlines suggest. They are not endings. They are inflection points. After the flush, what remains? When the noise dies. When the selling finally slows, something strange happens. The noise fades. The screens stop flashing. The panic headlines disappear. The urgency evaporates. And in that quiet, the truth begins to surface. This is the moment most people never study, because it isn't dramatic. There are no massive candles, no emotional spikes, no viral panic, just silence. And silence is where the real story lives, because markets don't reveal their intentions during chaos. They reveal them after. The final flush is loud. What comes next is quiet, and quiet is uncomfortable for people conditioned to react. But institutions thrive in quiet. This is when they return. This is when positioning begins. This is when narratives quietly reverse, like without permission, without apology. The silver market does not end after a crash. It resets. And resets are rarely obvious in real time. To understand what happens next, you must first understand what has ended. The year-end pressure is gone. The snapshot has been taken. The books are closed. The ratios are locked in. The regulatory guillotine has already fallen. And suddenly, the reason for selling disappears. Not gradually, instantly. There is no countdown, no announcement, just absence. Absence of forced liquidation, absence of mechanical pressure, absence of urgency. What remains is the asset itself, standing alone, stripped of leverage, stripped of emotion, stripped of excess. This is the most misunderstood state in financial markets, because it looks fragile. But it is not. It is clean. The silver market, after a final flush, is not weak. It is purified. Speculators are gone. Over-leveraged positions are gone. Tourists are gone. What remains are participants who can withstand time. And time is the most dangerous weapon in markets, because time exposes lies. The lie that silver is unnecessary, the lie that demand can vanish, the lie that paper systems can exist without consequence. Silver's role does not disappear because a chart turns red. Its role exists outside price. It exists in factories, in infrastructure, in energy systems, in medical supply chains. Solar panels do not care about sentiment. Electronics do not care about headlines. Industry does not pause because speculators were shaken out. Demand does not announce itself with urgency. It returns quietly, one order at a time, one contract at a time, one allocation at a time. And while retail waits for confirmation, institutions move. This is where the asymmetry begins. Retail investors need reassurance. Institutions need opportunity. Retail waits for green candles. Institutions buy when selling pressure ends. Retail looks for stories. Institutions look at flow, and flow, after a final flush, always tells the same story. Supply tightens, selling dries up, liquidity thins on the offer side. At first, nothing happens. That's the trap. Because people mistake stillness for weakness. But stillness is strength when pressure has been released. The silver market doesn't explode immediately after a flush. It stabilizes. Stability is dangerous for those who sold in fear, because stability forces reflection. Reflection leads to doubt, and doubt leads to regret. This is where psychology completes its cycle. Those who sold feel relief, briefly. Then they feel emptiness. They watch. They wait. They tell themselves they'll buy back when it's safe. But safety never arrives with an invitation. Markets don't ring bells at turning points. They move quietly until movement becomes undeniable. By then, positioning has already changed. This is the cruel elegance of financial markets. They reward those who act without needing emotional confirmation. They punish those who require comfort. Silver, more than almost any asset, exploits this dynamic because it sits permanently misunderstood, too industrial to be purely monetary, too monetary to be purely industrial. That ambiguity keeps it underappreciated until stress arrives, and stress always arrives. The same system that forces selling at year-end is the system that creates fragility elsewhere. Debt does not disappear. Deficits do not shrink. Monetary expansion does not reverse itself permanently. Pressure accumulates quietly until it must express itself. Silver is not insurance for calm periods. It is insurance for disorder, and disorder never announces itself politely. It arrives when confidence is highest. This is why silver behaves the way it does. Long periods of frustration, sudden violent moves, false breakdowns, explosive recoveries. This pattern is not accidental. It is structural. Now consider the broader picture. Central banks are trapped. They cannot normalize without breaking something. They cannot ease without debasing further. Every decision creates distortion. Those distortions must be absorbed somewhere. Sometimes in equities, sometimes in bonds, sometimes in currencies, and sometimes, when the pressure is right, in metals. Silver absorbs pressure because it sits outside the credit system. It has no counterparty risk, no default risk, no promise attached. That makes it inconvenient. And inconvenient assets are always suppressed until they are needed. The year-end crash was not suppression through force. It was suppression through necessity. Banks needed cash, funds needed compliance, the system needed to look stable, so silver was pushed down. But pressure does not destroy value. It reveals where value is misunderstood. Now, the aftermath of a final flush is not about predicting price. It is about recognizing regime change. A market that has expelled leverage behaves differently. Moves become sharper. Liquidity becomes thinner. Reversals become faster. This is why post-flush rallies feel violent. There's no overhead supply, no desperate sellers left. When demand returns, price must move to find sellers. That is when disbelief turns into panic, but in reverse. People don't panic buying because they want to. They panic because they realize they are underexposed. And underexposure feels just as painful as loss. This is the final irony. The same emotional machinery that forced people out will force them back in at higher prices. This is not moral judgment. It is behavioral math. And markets are ruthless mathematicians. Now, let's address the question that lingers unspoken. Was this avoidable? The answer is no. Year-end flushes are not mistakes. They are features. They are pressure valves. Without them, systems break catastrophically. Controlled pain prevents uncontrolled collapse. This is how modern finance survives. By distributing damage in bursts rather than all at once. Silver was one such release valve. And release valves always look ugly when they open. But once closed, pressure rebuilds elsewhere. The system does not resolve its contradictions. It postpones them. That postponement is where opportunity lives, but only for those who understand the difference between price and value. Price moves with urgency. Value moves with time. The final flush distorts price. Time restores value. That restoration is never linear. It is chaotic. It is unfair. It is emotionally taxing, which is why few people stay long enough to benefit. Silver does not reward certainty. It rewards endurance. Endurance through boredom. Endurance through doubt. Endurance through moments that feel wrong. That is why ownership concentrates after flushes. Those who remain are not smarter. They are calmer. They do not require validation. They understand that markets are not democratic. They do not vote. They transfer. The year-end crash was a transfer, from leveraged to unleveraged, from impatient to patient, from emotional to strategic. This transfer is invisible in headlines, but it defines outcomes. When history looks back, this moment will not be remembered as a crash. It will be remembered as a pivot, not because price reversed instantly, but because structure changed, and structure always wins. Silver does not need belief, it needs imbalance. And imbalance is built quietly after everyone stops paying attention. That is what comes after the flush, not fireworks. Foundation. The kind of foundation that supports violent moves later, when conditions demand it. Until then, the market will remain deceptively calm. That calm will frustrate traders, it will bore commentators, it will punish those who expect immediate resolution. But markets do not exist to entertain, they exist to test. And this test is simple. Can you separate noise from mechanism? Can you distinguish forced selling from genuine rejection? Can you sit in discomfort without inventing a story to escape it? Most cannot. That is why cycles repeat. That is why flushes work. And that is why silver remains exactly where it always has been, misunderstood, mistimed, and eventually revalued. The crash has ended. The pressure has passed. What remains is choice. Not the market's choice, yours. And markets remember which choices were made when it mattered most.